So I'm Eric Kundinger with Prevail Bank.
I'm Ben Hertel with Prevail Bank.
Yeah, and we'll go through a little bit more of our intros here in a second. But obviously today, we're kind of going to be talking about, developing a business plan and really all things lending. And, really what I would be looking for from you guys today, we'll keep it generally informal, but want to get as much value out of it as you guys possibly can. So if you have questions, just as we go through it, feel free to raise your hand or raise your hand virtually, and we'd be happy to answer those questions. It's awesome because it sounds like a lot of people are actually already in business. So it really gives us a really solid platform to kind of start from. So in terms of, just kind of my background, just in business in general, I grew up in a family of entrepreneurs, and we had many different types of businesses. None of them kind of really match up with each other. We had a fitness facility for a long time down in southeastern Wisconsin. Had a pizza place at the same time, which those definitely don't match up. And then what my parents probably had the most success with of all things was their small engine repair business. And a big part of that was that they didn't really actually ever have any formal business schooling, and they never had a formal business plan. And it really wasn't until the third time's the charm that they really, started to have the success they really wanted to have with it. As you would anticipate, kind of got the entrepreneurial bug myself. Kind of met my wife in college. I always told her I'd own a business and just never knew what it would be. I would 100% tell you the first thing was not a gym. And the first thing we owned was a franchise fitness gym. So as you would anticipate. So it's something I've always found some humor in. But we grew that. Actually, that was in the Marshfield area, and ended up selling that a couple of years ago. And then right now we've got a couple of real estate related businesses. So those are the things that I kind of do outside of my career at the bank, but they really all go hand in hand. I mean, I'm working with business owners each and every day. Absolutely love business, but talk about it all day, every day. So a little bit of a business background, kind of just common types of businesses that I work with, so you have a good idea of what that looks like. Do a lot of trucking and excavator related work, industrial related, and then also a lot of commercial real estate. I don't work with a lot of ag individuals. That's why I brought this expert. He deals with a lot more of that, and a lot of what you guys are saying. The kind of the different farming operations you have. Sorry, didn't mean much to me, but it definitely it probably hit chord with him. But just so you know, a little bit of that background, Ben. I don't know if you kind of give your background.
Yeah, Ben Hertel. Been in banking for 10 years. Prior to that, I graduated from UW River Falls back in 2012 with a degree in agricultural business and then soil science emphasis. Really kind of took a curveball route to get here. Originally was going into sports turf management, worked for Milwaukee Brewers, kind of went down that road, and then ended up in some turf sales that ended up turning into working in the co-op world after some personal life events that happened, and then through that I reached back out to a college professor of mine and I said, hey, look, don't know what the heck I want to do in my life, but it's certainly not the co-op world at that time. I was just burning myself out and everything else, and said, I want to stay in agriculture. That's where my passion is. Kind of grew up around agriculture, didn't grow up on a farm, but had plenty of friends that was always at their house and helping out on their farms. And she had recommended lending. And so her and her husband completely redid my resume. And within a week of getting that back, coincidentally, the previous institution I worked for reached out and said, hey, we have a position that's opening up. We have 2 aging ag lenders that we're looking to transition to the future. And, I ended up getting that job. Was a phenomenal experience. I primarily worked out of the Clark County markets. And I worked there for a little under 5 years, and at that point I was probably, I'd say 65-35 ag to traditional commercial in the loans that I did. Focused primarily on dairy, just being in the Clark County area, which has expanded since I've come to Prevail. I've been here about 5.5 years now, and when I got hired here, Prevail wasn't necessarily, we had some ag, but wasn't known as an ag bank. And I just straight up said, hey, if I'm coming here, it's going to be something we're going to have to consider, just because that's where my passion is. So since coming here, I'd say I flip-flopped from 65-35 ag to traditional to probably the opposite. But I've gotten a lot more into just straight cropping businesses, I've got a couple beef herds, a couple hog herds, and just have really kind of, I guess, expanded where my portfolio lands, not just in the Clark County area anymore. I get over here into the Stevens Point branch quite a bit.
So like because Cadobas in town.
There's a benefit of some restaurants in the area, but I am based out of our Marshfield branch. So for the most part, just do, traditional business, but then I bring in, and for the most part, anything that's agriculture that comes to our bank at least touches my desk at some point, whether I'm the one originating or just providing some insight just from my background and being in the industry my whole life. So,
yeah, I appreciate that. And probably didn't touch on it as well. I mean, been with Prevail, and we previous names before were River Cities previous to that. Been with them 12 plus years. But one thing to mention, we've always had a bit of an ag focus. We had a previous lender that helped start our Stevens Point branch, was in this market for 20 some years until he retired. And everything that was ag related really went through him. And actually, I don't remember, did you work with Nick at all?
I had
maybe just some brief passing. So as Nick retired, really, Ben is kind of our ag expert internally at the bank. What we'll kind of talk about, I'll go over just kind of some generalities, just kind of in some of the business startup process. But I guess question here, and obviously virtually as well, who here has ever created a business plan? Just by a show of hands. Yeah, kind of. I got a couple. Yep.
And then it's at least an attempt.
Yeah.
Yep.
And then who here, just by a show of hands again, has kind of gone through a lending process just on the business side? Anybody? Okay. Awesome. And like I said, it's awesome to hear that there are a lot of people that have existing operations. Again, there might be a lot of questions that come as it relates to just how does lending work, with businesses. So please just stop us and ask us questions as you go. If there's anything that prompts any thought. Otherwise, we'll kind of do our spiel, but please, you're going to get the most value of it just asking questions that you guys may have. But just some general business startup, like a couple people raised their hands with actually starting a formal business plan. That's kind of the foundation of what a bank is going to be looking for when we're considering financing for any type of business, especially, if it doesn't have a lot of history to it, there is a lot more reliance on that business plan. And that helps us kind of when we go through underwriting and make our decisions. But one of the things that's probably the most important for you guys as the business owner to kind of put that through its paces yourself. A business plan is, there's a lot of work that goes into it. It's a lot of kind of sweat equity, if you will, that you guys are going to put into that. But it ultimately, gives you the opportunity to have a bit of a better business. I always like to say, that is a living, breathing document. That's something that kind of guides your operations of what you want your business to be. And that changes over time. As you guys are in business 1 year, 10 years, 15 years, you can go back, revisit that business plan, revise it, if you will. And that's kind of about your mission and essentially what you're looking to do with the business. So it's really a great document outside of just starting your business as well. I've taught some stuff for Small Business Development Center at UWSB before. I think there was one lady who had revised her business plan 30 some times. That's probably on the extreme end. I think she was doing it literally every other month type of thing. But it's within reason. It's always something kind of good to look back at. But again, this is wanting to make sure that you guys are getting in a situation as you're starting a business that you're creating something that has an opportunity to succeed. And that's something that as the banks get in and they review the business plans as well, they're going to be able to see kind of who put that effort in for that business plan and, maybe who didn't. It kind of goes back to almost like school in a way, who put that effort in. I've seen some very simple business plans where they've been a couple pages. And then I've seen, where they're a lot more robust and they kind of have, more of the standard sections that you would essentially see with it. For those of you that haven't, I think done a business plan yourself, typically it's not the bank that's really helping you with that. There are other resources that are local or even kind of online as well that can help you really at low to no cost at all. Anyone familiar with Small Business Development Center at all? We got one nod there. Small Business Development Center, they are actually funded by the SBA. They are in a lot of the UW branches. They tend to be on campuses. We are fortunate enough, we got one here in town. that is a free resource for anybody that is looking to start up a business. And it's really great because they provide you a templated business plan that you can really start and work off of. So you're not starting from scratch. You're not sitting, just kind of a blank Word document and just kind of hoping it begins. You got something to kind of set you off with already. But then they'll also work with you too on the projection side as well. They can provide those documents to you, which can be a great resource, but they can also work with you one-on-one as well. I will always say, the ones that seem, probably the most invested in what they're trying to do tend to get their business plans done the quickest, and they'll work with you at your speed. I mean, maybe if you guys have other commitments, that can be a little bit longer. But maybe if it's something you're serious, you want to knock out as quickly as possible, maybe you need to get funding and, the bank's asking for a business plan and projection. That's something, again, they'll work with you at that speed to get that done as quickly as possible. But that's going to be one of the best resources that I think that you guys are going to have. So again, that's the Small Business Development Center. We have them in a lot of different counties. Again, they tend to be at UW campuses. They're funded by the SBA. So you're also fitting, just kind of a formatted template that most banks are probably pretty used to. But, again, as it relates to kind of doing the business plan, be able to have that kind of hand-holding or that one-on-one work with somebody and essentially not get a bill. That's phenomenal. It's a great resource that just not a lot of people know about. Some other things that they actually have an 8-week course for actually starting a business. And that can be a really good benefit for those that want to take it in a little bit more of a bite-sized chunks. And for those of you that are already in business, I've had business owners of mine that have gone into that and they've been in business 10, 15 years. Some of you, it sounds like a lot of you, you're always trying to learn something. That can be a great opportunity. There's a bit of a cost to that, but you do at the end of the course end up completing a business plan and projections, and that is basically what negates the majority, if not all, of that cost. But another one to potentially look into as well. I know in terms of actual projections, I think you said maybe FSA potentially helps with those, or
if you are going down the road of an FSA product, whether it's FSA guaranteed, you're starting to look at expansion of a herd or something like that, they're going to require a little bit more elaborate projections than, say, just doing a straight conventional loan. They may look at multi-year projections just because it is government subsidized and they do just have a little bit higher requirements with that. But working with the agent at the FSA office, in conjunction with that will help some of that as well. So the difference between, say, the FSA versus the SBA, some of the SBA stuff is direct lending. For the most part, FSA, we, the bank, are the customer, and then you are the customer to the bank. But then you're able to provide some guarantee. If you're looking at expansion programs, that maybe you have some blue sky that's tied to it, or you can't meet standard advance rates, stuff like that, we would bring that in on it. So,
I guess question for you, Ben, as well, as it relates to projections, and obviously you've got more of a background in the ag side, but is that something that sometimes you've done for customers to review their projections or even actually help put them together?
Yes, I guess that's one thing that we really, strive for at Prevail, and one thing that is instilled in us is we look to be a member of the team for any customer. Typically, it doesn't matter what kind of business you run. You have a financial team of your accountant, usually an insurance agent, sometimes an attorney, but then your banker as well. And so a lot of times I can model what somebody's looking to do based off of what some of the other people in my portfolio are doing. I say that with a grain of salt because I guess that's what drives me towards agriculture the most. And it's the same in business, but heavy in agriculture, where you can go to one farm, you can go down the road and see a farm that demographically seems exactly the same, and they're going to be completely opposite on how they do it. So you're going to be able to pick through things that work for certain individuals that don't work for others. One of the big ticket items as you're talking expansion, some people like to throw out the debt per cow and stuff like that. Ratios, me personally, couldn't care less. It's depending on what you're looking to do, does it make sense? And that number can be pretty drastically different for everybody in their operation. So really just kind of knowing where you want to go with it. when you're setting through your projections, hopefully you're looking to potentially contract some of your products for the end games, and then you know what your break even is. You know where you have to be to have a profit. And one of the biggest things, and this is more focused on expansion, but one of the biggest things that when you're going to expansion, you're talking about marketing animals and stuff like that. People tend to think of it as a earnings inhibitor sometimes and worry about what price they might be losing. But at the end of the day, if you're able to lock in a profit, you take it and run with it. Because then you know you're not going to see the downside risk with that. So just kind of being able to coach through that. Like at the same time, we're not necessarily doing a projection for our customers, but it's a way of guiding it through and providing different things to think about as you're walking through that based off of the experiences that we've had. So,
cool, appreciate it. Back to kind of just the business plan in general. I mean, one of the big things with it, I think kind of mentioned earlier, I mean, you're having an opportunity to kind of vet the opportunity that your guys are looking to do, right? And you got to see if it makes sense for you at the end of the day. You want to make sure that it actually, hopefully there's some sort of profit at the end of it for you. But it's something that, like, anytime I've ever done a business plan for any of our businesses, I'm always trying to figure out all the reasons I shouldn't do it. If not, if I figure out and go through the business plan, it still makes sense that, it might be a worthwhile opportunity. It is making it a more thoroughly thought out business. And that's what you want at the end of the day. There's a lot of things that, come in any business, whether it's in any industry, it doesn't really matter. That you got to be on top of. Obviously, competition is always going to be a big thing that you got to have kind of in your mind as well. And I'm sure that's no different in this industry too. Give you guys a bit of an idea of just kind of what the process is working working with a bank. I don't think anyone raised their hand in terms of actually kind of working with kind of true business lending, which is totally fine. I do actually have an article that I can provide you guys, and you can send out to some of the attendees just as a separate resource. It's just kind of a nice thing that kind of gives you almost a preparation of really how to work with a bank, how to work with a lender, how to give yourself the best chance if you're looking for some sort of funding to ultimately get that approved at the end of the day. Some of it's just kind of common sense, but some of it is realizing too, not a lot of people even that are already in business ever thought that they would be in business at all, and ever thought that they would need business lending. A lot of people, right, they have their house, that's a very simple way of lending. You hit your metrics and you get your appraisal and you got your loan in 45 days, 30 days. That tends to be how it works. On the business side, it's very different. I would say it's an incredibly gray area, which can make it difficult to navigate sometimes. It tends to lead to creative solutions. We could, have the same request from two customers, and they could have two entirely different situations, and that could be two entirely differently structured loans. So, I mean, I don't think you've seen probably any two deals be the same, even if they're the same customer type, amount, all that. I know I haven't.
Yeah, I mean, everything is just dictated on what that specific opportunity is, and you also factor in where you're looking to go from that as well. It's not always, as we build relationships, we know what the target is down the road. So sometimes you're structuring today's deal, planning for the next deal that you're looking at, or the next phase of what they're looking at doing. So that all kind of comes into play with it as well.
Awesome. But a bit of that process. I mean, if you guys are looking to just start, working with a bank, you need funding for part of your project that you guys are looking to do. Maybe you've gone and worked with SBDC or gone through ETP or even FSA. You've done your business plan, you got your projections. Now you're trying to go about funding. How do you figure that out? Obviously, it's reaching out to a potential lender and kind of interviewing them. I mean, honestly, for those that are looking to do something ag-related, I can just frankly tell you, I would not be your person, but I would gladly pass you on to Ben. You got to make sure you have a connection with someone that understands the industry that you guys are in. So that's where, having someone with an ag background, that's what you guys are doing. That's going to be really the best resource that you guys have. But you want to make sure, and I think Ben hit on it perfectly, you're looking at the opportunity that have now, but also to trying to understand what you guys are trying to do in the future as well is incredibly important. A banker can be a really good, really call it a part of your team, that is assisting you in what you're trying to do now, but then maybe what you're looking to, to kind of get to grow to as well. Kind of some of the standard things that a bank's going to be looking for. Just when you're looking for lending, you're typically going to be going a couple years of tax returns. We typically look at 3 years of personal and business tax returns if you have business tax returns. Have you complete a personal financial statement? That's really just listing out all your assets and liabilities. That gives us a good idea of just kind of what one's financial standing is. But two, because we can tend to look for creative solutions on the commercial side, it can kind of give us different ideas on ways to structure something potentially. Like you said, with no two deals really being the same, that can help a lender, the right lender, really decipher, how can we see a pathway forward to, help make what you guys are looking to do, actual reality. Obviously you'd have your business plan and projections that I'd be looking for as well. And I think as you guys are reaching out to banks, it's worthwhile to talk to a few lenders. I do that myself personally, just kind of on our business side. But you want to find someone that you jive with. You want to find someone that understands your industry. You want to find someone that really gets you and what you're looking to do. So they're going to go to their loan committee and they're going to fight on your behalf. And where getting really good information, timely information, and having a real well-completed business plan and projections, that's going to arm the lender with what they need to kind of put together a loan presentation. They will work with the analyst to put that together. Really what I say to customers, that's the story. That's the story about you, your business, and what you're looking to do, and then it's on the lender's, kind of side of things to really understand that and take that to committee to go seek an approval. We tend to have, not presentations where we're necessarily standing, but we do have a presentation scenario, and that is typically how a lender is going to go seek approval. So having that really good and strong relationship with a lender, someone that you know and trust, someone that you're able to kind of, give the right information to, you're going to have a really good opportunity to get, what you're looking to do get funded.
I guess I would just build off of that within the loan presentation as you get to that standpoint. Ultimately, your projections, the numbers, the analytics aspect of that comes down to where our credit analysts kind of step in and put that together. But us as lenders, it's our obligation to basically bring color to that presentation and really drive where that's going. The more that we know about your business, the more that we can advocate for you. I guess just my typical practice as an ag lender is I tend to be on farm whenever I am starting a new relationship. I tend to stop in on farm multiple times within the year just because A, if I have the time, I love to get out of the office. But B, just knowing what changes are happening. I guess one other thing I would highlight on is communication between you and your lender is huge. As you get to a point of you've built the business plan, you've got your financing, et cetera. This is agriculture. Stuff changes. Cycles come and go, and profitability is going to come and go. The more you are able to communicate and let your lender in on what's going on the front end, they can work with you a heck of a lot better than if you're not communicating. And some of my best customers, if you will, not necessarily best financial customers, but best customers are those that no matter what they're looking to do are giving me a call and saying, hey, I'm thinking about this idea. In no way, shape, or form is that me making a decision for your business. But at least I'm informed on what you're thinking of, whether you're making a change, you're looking at an expansion, you're looking at future goals. The more I'm able to know, again, the more I can advocate in the future. So I guess can't stress communication enough as you go through this process.
Yeah, 100%. If we had great communication all the time, that is kind of one of the single most important things. I can tell you too, those customers, if I were to just generalize, tend to communicate better throughout the whole process. It tends to just make things a heck of a lot easier throughout. And so, yeah, that's something definitely whoever you would work with would stress that you communicate as consistently as possible. And obviously, kind of as it relates to the lender, you want to make sure, it's a team approach. And they're kind of part of your team, and I've seen it kind of firsthand with kind of Ben's clients, and I think we both take great passion in it. If we feel we're armed with the things we need, we're armed with the information, the communication's been good, we've gone on site, we've gotten a lot of the information that we're able to kind of put, into that. I mean, these write-ups can be kind of large, right? There's a lot of financial tables, but then there's a lot of narrative too. We can take that then to committee, we can fight on your behalf, and we'd have a pretty good track record at coming out with a good approval. So, yeah, that will be one of the more important things that you guys would be looking to do. I don't know if you want to kind of speak to some of the ag-related stuff.
Yeah, I guess just as we were going through, talking about tax returns, stuff like that, obviously several of you already have operations established, whether it be on the smaller end, you might be looking to build on that someday or whatever else. I'm going to speak in generalities here. The agricultural industry typically is probably the largest advocates for not paying tax returns or not paying taxes, so therefore will try to work with their accountant to use as much expenses as possible so that at the end of the year they're not paying it. Right, wrong, or different, that's what your accountant is paid to do. But I guess the one thing that I would say is every once in a while you run into a scenario where there's just so many expenses that are being funneled through that kind of fall in the gray area, that at the end of the day, if you're making a profit, that's a good thing. And making a profit, you are going to have a tax liability. But for us to be able to really kind of work off of that, we have to have an understanding of where that true profitability is. And oftentimes it's based off of what those tax returns say. So I guess just throwing that bit out there. Otherwise, I guess, go ahead.
Would you say you consider changes in your total assets in addition to just whether or not that year's tax return shows a profit? If you're
correct, yep.
Maybe
So
you're not showing much of a profit, but on your tax return, but if you look
your
at
balance sheet
your
is
balance sheet total
increased,
assets,
for sure. And I guess that's one way that there are times where we as lenders, when you're operating based off this, you're operating based off a cash basis, right? So taking face value what your tax returns say at the end of the day, but there are certainly certain expense categories that can be utilized for buying equipment. And certain accountants will factor that in there, or capital improvement, stuff like that, that generally speaking aren't your operational expenses, so they're not going to be there year over year. So being able to dive deep into that and saying, okay, of what is being factored in here, what is true operational expense versus what is capital expenditures that we can net out that, hey, there's always the depreciation aspect because you bought new equipment. That one we factor out automatically because it's not a cash expense. So it's just knowing where those are. I guess that kind of brings me to one of the next points that I was going to make on this too, is having good record keeping is something that obviously the younger generations know technology more. They're able to utilize it as an asset and stuff like that, but having clarity in what your record keeping is. I think you had made the comment that you want to step backwards in technology rather than forward at the start of this. The biggest thing is just having good, clean, concise record keeping of what you're doing. Typically speaking, in the grazing community, you have a longer period from start to finish as far as some of your products go. So you're going to be expanding over a couple of years, or at least going over 1 year's tax aspect with it. So if you're going to be doing that, you want to be able to make accrual adjustments with your lender as well to allocate for, okay, if we are starting our herd here, these are all the inputs that went in to get the profit at the end of it, whether that's selling locally, whether that's marketing, however you're going about sale of your product at the end of the day.
Thank you.
Kind of brokers and stuff. That would keep going with that.
But yeah, I guess the other aspect is, for the most part, after hearing a lot of your introductions, a lot of you are on the smaller realm of production, right? And so unless you're looking to go into an expansion standpoint and then, having a conversation with brokers and being able to know where your profitability is, a lot of it's going to be sold more locally, generally speaking, right? I think you had mentioned some local market stuff, right? But then with the cattle too, were you selling locally?
Yeah.
Yeah. So, I mean, it's knowing your market and knowing where that's at, what the demand is for it. There's definitely, especially as prices go up in stores, have noticed that there's more of a demand to have local, just because if you're going to be paying a lot anyways, knowing what you're getting. I know my family has gone to a lot of the guys that I've gone to school with that have production and been able to go that route rather than, say, your Walmart and stuff like that. But you know, just knowing where your market is and having a great understanding of that, what the true demand is and what your market can sustain. For the most part, I think we're in a good supply demand chain for the smaller producer right now. If you have done a good job of marketing that product. Where you tend to get into issues is when you have too many producers in the area, which I wouldn't say necessarily the market that your smaller production right now is hitting is gonna go up against that. But if you do look to expand, then looking to have more of a marketing plan, being able to lock in profits, et cetera, depending on where you're selling your product. So,
Question for you, Ben.
yes.
So we have a lot of people here that already have, started their business to a degree, maybe have a couple of years of history as well. If they're coming to you, they want to start a relationship, looking for funding, and they might have a couple of years of history, would you be looking for a business plan, or what would you be looking for there?
I guess for me, it depends on what your goal is. If you're looking to kind of just looking for working capital needs, maybe have the ability to have a reserve established, whether it's an operating line of credit, be able to have some flexibility with inputs, et cetera. Land rent's going up, and so you want to just have a reserve available. Then typically we'll kind of go off of what historicals have shown. If there's going to be changes to your operation, expansion to your operation, then the business plan really comes into play, because you're no longer going based off of what history has shown, but you're looking at what you're looking to have in the future. So it kind of just depends on what stage of the process you're in and ultimately where you're looking to go, and whether that's, hey, this is my 12-month plan, this is my 3 to 5 year plan, this is my 10-year plan. Having that mapped out, and that's going to ultimately dictate how detailed we want to go into that. So appreciate that.
Can I ask you a question? From a money standpoint, so, what do people typically, can a $10,000 loan, a $50,000 loan, $1 million loan? I'm sure you guys have seen it all, but at my stage of the game, I'm not looking to take out any kind of long-term big loans. So more on a smaller scale, do you still work with that?
Yeah.
Things?
Yeah, I would say, I still have quite a bit of relationships over in the Clark County area, which within the Clark County area, a lot of the demographic is the Mennonite population over there. I would say I probably even today have a half dozen or more lines of credit that are peak limit of $15,000. In reality, as loans get bigger, yes, there are more details because more regulation goes into it. But at the end of the day, doing a $15,000 loan versus doing a $100,000 loan when it comes to a line of credit is very similar. The biggest thing is I'll revert back to the personal financial statement that you referred to before. Having a detailed personal financial statement that really kind of maps out what assets you have and what liabilities you have is going to really help facilitate us to what kind of limit we have for that.
That I have.
Yeah, perfect, yeah. So, whether we can secure it by real estate, if there's free and clear real estate, that's going to be phenomenal, because we're going to be able to take a line of credit and say, have a maturity date 5 years out the road. If we're looking at using cattle or equipment, then maybe we're shortening that a little bit and we're having a little bit more covenants, if you will, or hey, we're going to have to quarterly do a PFS update or get an equipment listing or a cattle listing and doing inspections like that just to make sure that, okay, we have this many cattle that are securing this loan, making sure that we're still within that guideline. Typical advance rates that you'll see within the industry on cattle and equipment in general is anywhere from 60 to 70%. So if you're buying a new cow, you know, you'd have a 30% down if you were just taking it at face value. Obviously, if you already have a herd, you're able to value the cattle you have based on what market values are and advance that at whatever that rate is. I think ours is 65. But generally speaking, you'll see anywhere from 60 to 70% on that. Equipment, whether it's purchase price, usually you can go out to like 80% advance rate on that. If we're just going based off of what market standards have shown, unless you're getting it appraised, then you're looking at more of that 65% again. The problem with, you know, if you're doing an equipment appraisal to really validate something, you're probably paying more for the equipment appraisal at that point. So it's not as common, I guess. But then real estate, obviously, then we can, again, go back out to 80% typically on that, and you're going to carry a lot more value.
So sorry, just to help me with terminology there, you're saying like annual advance rate at 60%. So if you have a inventory balance of $100,000 in your herd, you could effectively get a $60,000 loan to go buy some new heifers or something.
Correct. But at the other aspect of that is now you've also taken your herd size from 100,000 to 160,000. Mm-hmm. So ultimately, you'd be 60% of that now 160,000 is what the true advance rate is. Because you have $160,000 worth of assets that you would have availability. So now, are we going to go full advance rate on a line of credit? Probably not, but at the same time, just I guess face value to do simple math. That's where we
okay.
I think one thing to highlight too, I mean, with your question that you had for Ben, and kind of your explanation too, as you're talking about whether it's maybe real estate secured or secured elsewhere or otherwise, you can kind of start to see where some of that flexibility comes in, you know, on the commercial side where, you know, if we can use real estate, great, you know, and now we can push that, you know, basically that maturity out much longer, you know, and then it can be less of a hassle, right? Because then you're not doing maybe a lot, whether, you know, I guess paying attention to covenants, you know, different types of monitoring as well, you know, yeah, right, yeah, loan fees as well, and you know, and I think you asked too, I mean, you know, if it's 10, 15, 20,000, whatever that loan might be, you know, it's relative to your business. You know, we don't necessarily have any minimums. We'd have maximums, but, you know, there really are no minimums, you know, really at all. So, you know, I think it's keeping it relative to your business. I think it's, you know, that's where usually it starts with, you know, really good discussion with that lender and trying to understand kind of where you're at, what you're trying to do, and trying to craft the solution that works for you and your business. You know, this is far from a cookie cutter business by any means. And so really it is dependent on the lender and kind of you to kind of work through that to kind of figure out what's best for you at the end of the day. And maybe a couple different ways you can go about it. I mean, I think we both always like to kind of think of things creatively and try to come up with different solutions. And, you know, maybe there's one that you're more comfortable with than the other. That's just a part of that discussion process.
So you're like you mentioned, line of credit, and you know, I think home equity loan kind of thing, where you don't have to spend it all, but
correct.
Versus a regular, you know, term loan. Yep. What do you do both?
Absolutely. So yeah, so we do lines of credit, whether they're straight lines of credit or revolving lines of credit. Difference being revolving line, so you have a 24-month term, $40,000 revolving line. As you can borrow against it, pay it back, borrow against it, pay it back. We're
very much like the HELOC.
Correct, yeah. Or even your credit card is technically an unsecured revolving line. A straight line of credit, you have a peak limit that as you go along, you can disperse against that, and you have 40,000. So if I was just looking at a cropping note on a dairy operation and we were just doing an annual cropping note, then hey, we are advancing up to $50,000. and you can use 20,000 here at the beginning of the year. In the summer, you need another installment at another 20,000, and then 10,000 towards the end. It all gets paid back at the end of the year. You can't. It's not revolving where you pay it back and then you start again. It's just set for that year. Term loan, typically, you will be, you know, if you're buying a piece of equipment, we're going to term it out over 5 years. It's just like buying a car where you buy it and then you have a set payment to pay it off in that year. And then real estate is just going to be the same as the term effectively or installment loan, and it's just going to be a lot further out.
And how do interest rates factor into, do you follow on
Yeah.
time? Do you?
Yeah, so
Great question.
right. I would say the number one question we get as a lender, or after you hear about what the proposed opportunity is what's my rate going to be? And the nice thing about our commercial side or agricultural side versus, say, the mortgage side is we don't have just a straight rate sheet that we abide to. For us, you know, we have our metrics that we look at that really kind of dictate, hey, based off of where our funding is on the bank side, where we need to be for a margin over a certain index or something like that. But ultimately, where that margin gets dictated is going to be based off of what the overall relationship looks like. Do we have deposits with it? Where do we stand for a loan to value perspective? You know, stuff like that, where it really dives down into the risk assessment of that loan and the potential for it to go bad. If you have, you know, a scenario where you have significant net worth, where you have the ability to have some flexibility there, that's less risk to us. If we have a scenario where, okay, you're looking for a $50,000 loan, but you have average deposits of $20,000, something like that, well, now you're funding effectively at 0% interest a certain portion of your loan. So therefore, having that is beneficial to us, so it provides us a little bit of flexibility with that rate. But there's never, I guess on our end, we don't have a set rate schedule, and it all just kind of comes down to the overall relationship. When somebody asks us that, quite frankly, I just take the perspective of, okay, here's kind of the average rate that I've given out recently, and I say give or take 25, 30 basis points. And I've always taken the model that I'd rather tell you a higher number and produce a lot less, because quite often people tend to hear what they want to hear sometimes with that rate. And if you say 7.25 and all of a sudden you come back at 7.4, they're bringing that back. So it's a lot easier to come down than it is to go up. So, but a lot of it is risk related and how it fits within the bank's balance sheet at the time and where we're looking to go. Are we in growth mode? Are we in maintenance mode? Stuff like that. So
I think to even add on to that, and I'll kind of generally do the same. I mean, I'll give a range, you know, just kind of this is what we're funding most things at any given time. You know, obviously you guys can, most people that like have a house or a home and pay attention, like 30-year mortgage rates, you know, I usually say add a point or a percent onto that. That's probably gets you in the ballpark with even calling a, you know, commercial bank to where maybe commercial rates are sitting at that point. It's not perfect, but it's just a real generality. But then I think too, you know, the other thing to highlight as well, if you know you have, and I'm speaking at this from like the business owner perspective now, if you know you have a really good relationship with your banker, they understand your business through and through. They, you know, maybe they've helped you in, you know, good times, tough times, whatever that might be. But you have, you know, you absolutely know, you know, that they know your business better than any other banker maybe could. It's not always about rate at the end of the day. I mean, I think of that in my own lending relationships with who I work on the real estate side. It's important, no doubt. And I'm never going to kind of push for the lowest possible rate. I know, you know, that, you know, I've got a good solid banker. They understand what we're doing. They're fighting on our behalf. They always come through with a yes, you know, and it facilitates, you know, what we're trying to do, and they believe in us. To me, that's worth something, and I'm kind of, you know, frankly, I'm okay with paying that a little bit. Like I said, I'm not trying to get overcharged by any means, but, you know, just, we do see sometimes customers get really hung up on what's that rate, what's that rate, what's that rate, you know, as low as possible, and it's just, that's not the only game, I don't think. I think you're looking for a lender that you hope to be a really long-term partner for you. You know, I think a good lender, a good accountant, those are probably two of your biggest ones. Those are, and your good insurance, business insurance agent as well. Those are your teammates that are in your corner, that kind of really help stabilize your business. So, a banker would be a huge piece of that.
There's certainly an aspect of that, of knowing where you want to go versus just a transactional banker. That's, I guess, the biggest part of it. I'll forgive you this time. So just knowing that, I've had customers that I used to bank with at the previous institution that I'm still looking to transition over just because I happened to come to Prevail in late 2019. So then right when COVID hit, interest rates dropped, and there's a lot of refinance premiums put on some of their notes at the previous institution. So, and I guess just to highlight on that, prepayment penalties, I guess from a certain aspect, a lot of banks use the verbiage. Me personally, I don't like prepayment penalties. I work for you, the customer. If you come in tomorrow and quite frankly, you won the lottery and you want to pay off your stuff, hey, awesome. What's our next endeavor? If I am getting a payoff from another institution, that's a little bit different story. So we tend to use refinance premiums a little bit differently, because oftentimes when we're securing financing for you, we're again basing that based off what our balance sheet shows at that time. Do we have a lot of CDs in our portfolio that we're paying out a certain interest rate that we need to maintain a certain margin, et cetera? Now, again, say you lock in an interest rate today, 3 years in, it's a 5-year term, 3 years from now, rates drop. Does that mean that we're not going to work with you and, we're going to stick you to that refinance premium? No. Again, having that relationship with your lender and being able to communicate with them of where things are at to get to an end goal that works for everybody else is always at play. But if I'm just straight up because rates dropped 0.5%, handed a payoff from another institution, then that's when those tend to get enforced. So I guess just some of the terminology within banking that kind of gets thrown out there is kind of fearful more so. Straight prepayments, unless we're doing special programs where they're debenture funding or something like that, where they're tied to that, but that's all disclosed on the front end. And that's usually not a conventional loan. So,
Well, I know you had probably just a couple more things. Maybe you just want to touch on market risk and the FSA guarantee, and we could probably get into some Q&A as well. Appreciate all your questions as well.
Yeah, I guess just market risk is obviously you guys, for the most part, have already established businesses and kind of what you're looking at, and you're on the more the smaller side, so you're not as highly impacted by the market as if you were seeing high commodities fluctuations. But as you look, if you were looking to expand, and I keep referring to the expansion process because ultimately, if you're looking at business plans and stuff like that, typically you're looking at growing your herd or maybe expanding on that. So the FSA guarantee really is a decent program that if you are expanding or starting up and don't have a lot of maybe working capital available to you, or you don't have the net worth or the assets available to you, say you're coming up short on those advance rates, that FSA guarantee is able to come in and help maybe facilitate some of that blue sky that might be sitting out there, that to help you get to an end goal. The other big benefit of that is an FSA guarantee will allow us to take lines of credit out for longer than a year, and have the guarantee still tied to it. So those are kind of the big highlights, especially at this level of production, that I guess I would highlight on. There are other FSA loan programs that can help with beginning farmers, stuff like that, but those tend to be more revolving around buying land and stuff like that. And certainly things that, I guess, if you're in that realm and you want to have conversations about that, I definitely kind of go down that path, I guess, independently from this discussion, and something we can look at a little deeper. So,
cool. We'll get to Q&A here in a second. Like I said, I'll send you guys, or give you guys that article. You can pass it around to these individuals and maybe just send it to them if you have emails. I've got my card and Ben's card up here as well. And we kind of talked about, developing a business plan, right? We don't really go through the sections themselves, but, I think the big part to say is that there is help that is out there. So any of you guys that are looking to potentially actually write a business plan, a formal business plan, I think SBDC is really going to be probably one of your best resources. If you want, you can grab my card, shoot me an email. I'm happy to send an introduction email with Patrick and his team over there, just so you're connected and you can kind of get started working with them. Otherwise, you can find them online as well, but happy to make that connection if I can. Yeah, other than that, what questions would you guys have?
I have one more.
Please. Yeah, go at it.
So we do have an LLC in the business name, but everything is still just under our, personal, any banking we do, anything, taxes, all that stuff.
Yep.
So with a business loan, do you need to have it done under the business name, or can it be done under personal name, or are there pros and cons on both sides? How does that work? I need a lawyer.
So not necessarily. No, it's not uncommon with what you're saying at all.
So quite frankly, anytime you're talking about an LLC versus an individual sole proprietorship, because an LLC can still be a sole proprietorship, right? Anytime that question kind of comes up, I always refer it back to the accountant. Typically speaking, the reason you're bringing the LLC in is A, from a liability perspective, avoiding a lawsuit, right? Or B, it comes into a tax perspective, is there benefits to it? So I always kind of refer it back to them. But from the perspective of us, from a banking perspective, we can set up loans individually. We can set up loans to an entity. It really doesn't matter. It just kind of fits what your structure of everything works or kind of looks like. Typically speaking, if we're borrowing to the LLC, even from a loan perspective, well, the LLC will be the borrower, but then the owners of the LLC, assuming it's a sole proprietor, for example, would be a guarantor on that. And the biggest thought process, I guess, I kind of relate back to with that is every once in a while, you will get a little pushback on, hey, I created an LLC to minimize my liability and remove my liability. Yes, from being able to separate business and personal stuff, maybe in a lawsuit, something like that. But the way I guess I've always looked at it is, you as the customer, if you're coming to me asking me as the banker to back your business, but yet you're avoiding being a guarantor because you won't, to me that shows that you won't personally back your business yourself. So you're asking me to believe in your business when I would question whether or not you truly believe in it, right? So that's kind of how we typically structure it is, if we are doing that legal entities, the legal entity will be the borrower and then individually be a guarantor. But certainly if you're looking to do it as, hey, my spouse and I are doing this individually, we have the operating entity as just for tax purposes, we can do it that way too. We might bring the LLC in as a guarantor at that point if they're the ones making the income to then make the loan payment. Again, falls right into the flexibility of the structure.
I'd like to add to that as well. So you said you have an LLC already, but then you kind of have a lot of your personal accounts set up. More from a liability perspective than anything. You tend to commingle it like that. If there was essentially a liability issue or a legal issue that were to arise, they tend to call it piercing the veil. So now it would expose potentially, if there was an issue with the business and that was getting sued, the fact that you might have those personal accounts and stuff running through there could expose personal assets as well, in those things. So at least worth just, it's a good question, worth just talking, whether it be to your accountant maybe to start with, even getting a legal opinion on it of, should we have it all within the LLC or do we maintain this all personally? What are they going to suggest? But yeah, usually at the end of the day, you're just trying to mitigate risk, right? And that's what you don't want to make sure. You don't want to, get hit with a lawsuit or anything like that. And now it opens up all your personal assets to it. That would be kind of the point of, creating that LLC in the first place, is to gather some of those protections. Yeah, good question. Thank you.
So get all over.
Yeah, there's business lawyers in the area, certainly, and I'm sure we've got recommendations as well, people that we work with, but it's one, like I said, piercing the veil is the technical term for that. And it's, realistically, I mean, yeah, maybe you're okay with that. I mean, at the end of the day, some people are okay with that risk. But, if it's something that keeps you up at night, I would just seek that legal opinion and just, kind of see what they suggest and kind of follow through probably with what they're, asking, or advising you with. Yeah, go ahead.
Can you say more about the risk of taking on a business loan like this? Like we're talking about being a personal guarantor on a loan or backing something up with property. Can you say more about what the risk are?
It's a loaded question. It's a great question. Oh God, the risk. I mean, at the end of the day, I mean, if you're looking for business funding, and business funding, it tends to just be more risky, right? Not all businesses make it, unfortunately. But the fact that you have some backing, out there. I mean, when we started our gym, I'll tell you, we had our house secure, our line of credit to start that thing. Did that make me super comfortable? Hell no, not at all. But it was something that certainly that was a means to do what we were trying to do and build. So we had to kind of find comfort with that. So there is, inherently a risk to doing it. And so I would say kind of to the individual or to the customer, that's what are you comfortable with doing? Not everybody is comfortable with doing that at all. And some people, and I'm sure we've had these discussions, they'll draw a hard line. Maybe people's largest asset tends to be their house, right? That's where they got the most equity. That's where potentially, if they're looking to go do something, short of taking the money out in like a second mortgage or a HELOC, they might have to pledge that as collateral for any type of business, any industry. And we see it all the time. Some people, they draw that hard line, at not being willing to pledge it, and that's fine. They got to figure out a different way than to potentially either come in with cash or additional collateral, friends and family, those types of things that kind of might be the resources that assist with making a project go. But I would say that starts with those that are trying to start a business, and that goes back to I think even the business plan itself. That's you putting the business through its paces. Does this even make sense for me to do? Is this worthwhile? Are the risks worth the reward? If they are, great. And you've mitigated, maybe some of the potential pitfalls that you might run into in your business, or you've at least thought about them, so you're not surprised if you see them. Now you're more prepared. I've seen a lot of business. I can think of one for sure that, sat across me and, said, I've got a lot of $1 million ideas, and and they didn't anticipate that they would have any trouble starting this business. COVID hit, and they were out of business pretty quickly. And they had pledged a lot of assets, but they didn't do a lot of the due diligence that they should have done. And it was something we didn't end up financing that deal, but someone did. And they probably lost a lot, and that's not great. So, the risk starts with you. You got to put things through its paces. You got to feel comfortable in doing this stuff. You're the one that has to sleep at night. I mean, that's really kind of me speaking to you as a business owner as well. I mean, business ownership isn't an easy thing by any means. I can tell you, like I said, it wasn't enjoyable to have our house securing a line of credit by any means. And, that line of credit wasn't even large. It was $30,000 at that time, but that felt monstrous. And, at that point in time, it felt like I mortgaged our whole house and our whole future, and better hope it worked out. So, so some of the things that you just got to be comfortable with it. I've got a project right now we're working on in kind of the central part of the state. 2 individuals looking to start a new business. Try to not give you a ton of details, but there's a bar restaurant component to it. They're coming to me. They gave me a business plan, full-fledged projections. They're keeping their jobs. They're both willing to pledge their houses. One of them has an investment property. Like, they're all in. They're really wanting to make their project go. They will do it at all costs, which is great. It gives them an opportunity that maybe we can find a pathway to fund something. But if you're thinking of potentially, if you've got other assets that you guys would pledge, you just gotta you've got to have that comfort with doing so. And if you don't, that's fine, but maybe there's a different way, you know, and that's where we kind of talked earlier about like reviewing a PFS. Maybe we don't need to take outs. Maybe there's, you know, some people have a lot of different types of other assets that maybe we can look to leverage, or we can give you feedback where maybe if we're not the right funding source, maybe we know someone is that can be a bit more flexible on collateral as well. Hopefully that answers your question. I don't know if you got anything to add there.
I guess the only other aspect that would potentially come in there too is that's where maybe some of the government-backed opportunities come into play, whether it's SBA or FSA. You know, it might be a way to avoid maybe utilizing real estate in the long run. Typically speaking, those guaranteed programs more often than not do have higher pricing than a conventional route, just because you are effectively paying for that guarantee. So your cost of operation is going to be a little bit higher, but it, you know, comes down to your risk assessment. Are you better off utilizing the home and having cheaper cost of funds, or paying a little bit more for an opportunity that doesn't bring that in? So ultimately, it comes down to your risk tolerance and stuff like that. But yeah, I guess that's the biggest thing I'd add.
I think the other thing to even add with that too, I mean, you know, just conventional lending, you know, there is SBA lending as well. You know, they provide guarantees, and that, you know, that could be a means to get a bank comfortable where, you know, you don't have to pledge personal assets that you may not want to. So there's more than one way to go about it. There tends to be, you know, with the right banks, you know, they're aware of, you know, whether the conventional, obviously, programs that they offer, you know, just as a standard, but then other, you know, programs that might exist for customers as well, that they can actually utilize too within the bank. So usually more than one way to go about it. Any other questions you guys got?
Online, folks? Yeah.
Quiet.
Means we either did a good job or we're off our roster.
When you say projections for an ag type business expansion, how, I mean, I know the idea is you kind of look at best case and worst case, but what kind of backing do you expect to see for those projections? I mean, if you've got, say you've got a couple of years of prices from selling calves, and you say those are going to stay the same for the next 4 years.
Right. I guess just from, you know, the last 10 years experience right now, going to an auction site and what cattle are selling for today compared to a couple of years ago is absolutely ridiculous. So I guess I've always typically tried, in agriculture, we've kind of always sat in this realm where we have called a 5-year cycle, where you have one bad year in there, you have one really good year in there, and then you have 3 that are average. I usually try and take the average of those to really kind of dictate when I'm doing advance rates for what I'm going to value those cattle at. And I guess for projection, I would expect to maintain that same thing, because yes, you're going to have your down year. Yes, you're going to have your good year. But if you're constantly, like if I was taking advance rates against what cattle prices are right now versus what they were 3 years ago, I'm going to have to come back and readjust that when markets inevitably come down at some point, right? Where if I just have an average across the board and just kind of maintain that, when we do go in the down year, then I don't necessarily need to peel back on that. I can just kind of maintain that. So when putting together your business plan, I guess I would always focus on what an average year is, and don't be afraid to say, hey, here's a model that shows a bad year, here's a model that shows an average year, here's a model that shows a good year. Because what we tend to look at too is stress testing, of saying, okay, you know, whether it's you're taking out a line of credit and that's a variable rate that's usually tied to prime, well, we always do a 2% stress test to that. So if rates were jumped to, you know, 2% at some point within that term, what does that look like? So doing your own stress testing of, hey, this is what I anticipate for income, but what happens if revenue drops 20%? What happens if it jumps 20%? Something like that.
So you wouldn't expect to see today's price on there or 2012 price, but the average of the last 5 years maybe?
Yeah, I'd say focus more on maybe like 2019, 2020 numbers. Yeah, right now, I think the last time I talked to a couple auctioneers from time to time, and they had sold a 3-day-old calf at 900 some bucks, and I was just like, yeah, I think I'm putting that on a balance sheet anytime soon. So, right now pricing is just rough, but eventually, history says it's going to come back. So, just trying to focus on an average on that.
I might have heard this wrong, but did one of you say earlier that you can sometimes estimate an ag loan is going to be a 1% greater than a home loan for interest rate?
Yeah, I was just saying generalities from like a commercial rate perspective. This can definitely vary wildly by financial institution, but if you go look at like a U.S. bank or Prevail bank, any bank's 30-year mortgage rate, I think 30-year mortgage rate is still at 7, right?
Right.
Or maybe just short of 7 right now.
Yeah.
So let's call it 6 3/4. Add a point onto that, or 1%, in thereabouts at 7.75. That probably plus or minus that 30 to 50 basis points that gets you a range of where you'd likely be. So, like I said, it's not perfect, but that's what I've generally seen over the years, and it gets you in the ballpark of what commercial rates might be at any given time. That's, you guys can go look that up and kind of add that 1 point without even calling a bank and have an idea like, okay, yeah, that's probably where it'd be. And then as you would go through the process, you'd figure out a little bit more, I guess you'd pinpoint it down much further than that, especially if you had a need, a lending need, and you're going to work towards the loan process.
And our commercial loan rate the same as ag loan rate?
Tend to be
relative. Again, everything kind of goes down to the risk assessment on it, right? And I guess, in the context we're talking right now is fixed rate financing, so it's going to be your term and your installment loans, real estate loans, stuff like that. Real estate is going to tend to be cheaper than an installment loan. A line of credit is always going to, vast majority of the time, be tied to prime, which right now is 7.25.
Yep.
So usually factor a margin if, are really strong operations, established operations, they might be at prime itself. Startup operations, stuff like that tend to carry a little bit more risk. They might be prime plus 1. So it'd be 8.25, for that. And it just kind of depends on where that risk assessment is. But your lines of credit are typically going to be tied to a variable rate because they're usually looking at over a 1-year time versus the fixed rate financing for the next 5 years.
And we'll see it a lot in, people will underwrite their own deals and, maybe they send it to us. Tend to see this probably more in the real estate realm than anything, and they'll send us their underwriting, they'll send like a plug rate, even, I don't know, I'd say lower than the 30-year mortgage rate sometimes. And so they're not even underwriting their own deal with a rate that's even in the right sphere. So they might show that they got a deal that makes sense, but when you actually plug, kind of a more relative rate, maybe it doesn't. But yeah, I think you just want to, like, when you're running numbers kind of for your own self, you want to make sure you got something that you think to be fairly accurate. So like I said, that gets you in the ballpark. And then kind of if you had a relationship with a lender, we probably get it all the time, just an email, hey, what are commercial rates today? And that is a tough question because there isn't just like a set rate like you would get on, the 30-year mortgage or just on the, the personal mortgage side. But
it's a lot easier to answer that question when you know what's going on versus just getting a random off.
Yeah, 100%. Yeah, we give you that range. Yeah. And that's usually probably more of the deals that we've seen probably in the last 3-4 months, what they've been funding at. So pretty accurate of kind of where we anticipate to be. And then two, just where the general rate environment is. For as low as they were just 3-4 years ago, we're obviously in a bit of a higher rate environment now. There's obviously been a lot of speculation that we would see rates go down. We obviously haven't really seen that. So we've really been in kind of a month-by-month basis here for probably the better part of 2 years. There's a lot of things that we pay attention to, kind of more forward-looking with the prospects of rates. But think too, recently we had an election. Obviously, you have a new administration in there. So, I mean, there are just some things that are heightening, maybe potentially just still the rate environment and changes that are coming with that. So we'll see how a lot of this plays out. But, I mean, we would anticipate, hopefully, at some point in time that we do start seeing some more measurable movements down. I think it'll be interesting this year, but it seems like this year might be pretty flat just for rates. See if there's any more questions. Anybody else? Mm-hmm.
I do have one more.
Please, go ahead.
Are you okay with this?
Yeah, and they might have the same, so yeah, please go ahead.
So if you're gonna attach, let's just say my house as collateral, why, and, okay, I want $50,000, why not just get a home equity line of credit versus a business loan for you guys? What would be the advantage of doing?
I would say overall this comes back to accounting. You can certainly use a home equity for it, but then you're not going to be in the entity tied to it. So when it comes to interest expense, stuff like that, your accountant might recommend to have it on the business side. Again, separates everything. Typically speaking, home equity lines of credit tend to have like a $50 annual fee. So, I mean, you could break down even that level of benefit. You can effectively take an egg line of credit and have it be a home equity line because you're utilizing your home. But it also comes down to the other aspect of this is depending on what your home site looks like. Do you have an old farmstead where you have farm buildings that some traditional mortgage companies wouldn't look at? Or wouldn't qualify for, say, like secondary market, and it has to go conventional, and then it gets deemed as a farm real estate versus a traditional mortgage, stuff like that. I guess there's a lot of different things in play there, but I would say a lot of it comes back to how your accountant is looking to do the bookkeeping with that, and then ultimately liability.
We had one question in the chat. I can read it for Monica. It says, if you invest your own personal money into your farm business, how do you suggest to pay yourself back? And also, how do you show that on your taxes? Further explanation, if you had no huge income from your farm last year, but you purchased a big machine, the money came from your personal savings.
I can go with my answer, you
go
with
ahead.
yours.
Yeah.
But, I think with that in terms of, if their anticipation is that they see the business pays them back, really what you'd likely do is you class that as a contribution. This would be something you work with your accountant on. What that would do is that probably sit on the balance sheet, essentially as a liability, essentially to get paid back. So basically a loan from shareholder type of thing. So, there wouldn't be maybe a defined repayment that is set out, but it would sit there on the business's balance sheet, I guess effectively call it to be repaid at a later date. And obviously too, I mean, one thing to mention, with small business, personal and business, accounts do, it happens a ton, get incredibly commingled. So I wouldn't say in all cases that anyone or that everyone's looking to kind of repay themselves back. But again, if they were, that would just be making sure that it sits on the balance sheet, and that would keep record of it. And then at a point in time, I guess if the business has the ability to, could pay them back personally and pay that loan off.
Or if it was in a position where you built the business up and then were to sell it in the future, then it gets allocated within that sale. But yeah, I'll stick with that answer.
Yeah, no, you're right.
Thanks a lot for coming out.
Cool.
Eric and Ben.
Yeah, sure thing.
We can hang out here and mingle and, keep the conversation going, but I would really appreciate you because
Cool. Yeah, thank you for your guys' time. Again, cards are up here if you guys need anything. If you guys want that connection to SBDC, happy to give that. Like I said, I'll give you guys that article so you guys can pass it around.